Imagine waking up to find $41 trillion vanishing from the U.S. economy. That's not the plot of a sci-fi thriller. It's the reality some analysts warn we could face if investor flight continues. And now Bank of America is sounding the alarm, suggesting that America's financial foundation might be cracking. What's driving this mass exodus? Who's pulling their money out? And what does it mean for your savings, your job, and the future of the dollar? Something significant is unfolding beneath the surface of the U.S. economy, and it's not getting the attention it deserves. New estimates circulating among top financial institutions suggest that as much as $41 trillion in capital, that's right, $41 trillion, is at risk of fleeing the United States in the coming years if current trends persist. This isn't just a number. It represents the backbone of America's economic strength, foreign investment, stock market stability, government bonds, and the demand for the U.S. dollar itself. So what's going on? To grasp the scale, we need to understand what that $41 trillion actually represents. It comes from foreign holdings in U.S. equities, bonds, real estate, and reserves. Over the past several decades, the U.S. has benefited greatly from being the preferred destination for global wealth. Investors from China, Japan, Saudi Arabia, Europe, and beyond have poured trillions into U.S. assets, trusting the country's economic and legal stability. But now that trust is starting to unravel. In the past year, we've seen serious signs of outflows. China has slashed its holdings of U.S. Treasuries to their lowest level in over a decade. Saudi Arabia is quietly selling off U.S. assets. Central banks worldwide are rebalancing their portfolios, moving away from the dollar and into gold or other currencies. Meanwhile, in Washington, political chaos, debt ceiling fights, rising instability, and ballooning deficits are raising red flags for investors. And then there's the dollar itself. Once seen as the ultimate safe haven, the U.S. dollar is now facing challenges from multiple fronts. BRICS nations are developing alternative payment systems, and countries like Brazil, India, and Russia are exploring trade in local currencies. Even U.S. allies are starting to question long-term dependence on the dollar. Now here's the kicker. Bank of America recently issued a warning that if these capital outflows continue to accelerate, the economic consequences could be catastrophic, not just for Wall Street, but for everyday Americans. Stocks could crash, interest rates could skyrocket, the dollar could weaken dramatically, leading to inflation and higher costs across the board. This isn't just about global finance. It's about whether the U.S. can maintain its position as the world's economic anchor. Right now, that anchor is starting to look dangerously loose. The exodus of capital from the U.S. isn't happening in a vacuum. It's the result of growing anxiety among foreign investors, central banks, and multinational institutions that are watching U.S. policy and markets with increasing concern. But what's driving this wave of divestment? First, there's geopolitical instability. In recent years, the U.S. has engaged in escalating trade wars, particularly with China, and imposed sweeping sanctions on dozens of countries. While these actions may align with certain foreign policy goals, they've also undermined trust in the U.S. as a reliable economic partner. Countries that once felt secure holding U.S. assets now fear exposure to political retaliation or asset freezes. Second, there's the debt explosion. The U.S. national debt has surpassed $35 trillion, and continues to grow at an alarming rate. Foreign buyers, especially those from Asia and the Middle East, are questioning the sustainability of this borrowing. Will the U.S. continue printing money and devaluing debt? If so, holding U.S. Treasury bonds becomes a much riskier proposition. The higher the debt climbs, the greater the risk premium grows, making America less attractive as a safe haven. Third, the Federal Reserve's unpredictable monetary policy is another source of uncertainty. After a period of ultra-low interest rates, the Fed pivoted sharply to aggressive rate hikes to combat inflation. While these moves are designed to restore price stability, they've destabilized bond markets, fueled recession fears, and caused foreign investors to second-guess the Fed's long-term direction. And finally, there's the global movement toward de-dollarization. BRICS countries are leading the charge, but they're not alone. Countries like France have conducted oil transactions in yuan, while the UAE and India are experimenting with rupee-based payments. These aren't isolated incidents, they're early signs of a fundamental shift in global finance. All of this adds up to a clear message. Foreign investors are no longer blindly trusting the U.S. economy. They're diversifying their holdings, hedging their bets, and in many cases, pulling money out of American markets altogether. This shift is not just symbolic, it's material. When foreign capital flows in, it fuels growth. When it flows out, it can trigger a crisis. And right now, the tide is running in the wrong direction. Bank of America recently released a research note that has sent ripples through the investment world. The core message: America's financial dominance is no longer guaranteed, and the warning signs are multiplying. According to Bank of America analysts, the U.S. is entering a new era of structural vulnerability. Simply put, the very foundation of the American financial system, foreign capital, trust in the dollar, and demand for U.S. securities is eroding. While this shift won't happen overnight, Bank of America is urging clients to prepare for a world where U.S. assets are no longer seen as the ultimate safe haven. One of the key points in the report is the decline in foreign participation in U.S. bond markets. Over the past decade, foreign central banks were the top buyers of U.S. Treasuries, helping to support America's borrowing needs and keep interest rates low. But now China's holdings have dropped below $800 billion, the lowest level since 2009. Japan is slowly divesting, and even allies like Germany are reducing their exposure. In Bank of America's words, the marginal foreign buyer is disappearing. The report also highlights growing interest in alternative assets, especially gold, commodities, and emerging market currencies. Central banks in BRICS countries, the Middle East, and even parts of Europe are increasing their gold reserves at the fastest pace in decades. Why? Because gold isn't subject to U.S. sanctions or monetary policy. It's seen as a hedge against both inflation and geopolitical risk. Another crucial insight from the report is the danger of a self-reinforcing cycle. As more investors begin to doubt the long-term safety of U.S. assets, they start pulling out, causing market volatility. That volatility, in turn, reinforces the belief that the U.S. is no longer stable, pushing even more capital out. Bank of America refers to this as the confidence spiral and warns that it could accelerate unless addressed through fiscal reform and geopolitical stabilization. Finally, Bank of America cautions that American policymakers are underestimating the long-term consequences. Temporary fixes like interest rate adjustments or short-term trade shifts won't solve the deeper issue. Global trust in America's financial leadership is cracking. The report ends with a stark message: markets can endure risk, but they can't endure uncertainty forever. If the warnings from Bank of America and other analysts turn into reality and capital begins to flee the United States at scale, the consequences will be severe, not just for Wall Street, but for every corner of the American economy. So, what exactly happens when trillions of dollars start flowing out? Let's start with the bond market, the backbone of U.S. government financing. As foreign investors reduce their holdings of U.S. Treasuries, demand for bonds drops, meaning yields must rise to attract new buyers. While that might seem beneficial for savers, it spells disaster for the government, which will have to pay much more to borrow. With over $35 trillion in debt, even a 1% increase in interest rates could cost the U.S. hundreds of billions annually in additional interest payments. This brings us to the next domino, the stock market. Foreign investors are major players in U.S. equities, holding trillions in American tech, energy, and banking stocks. A large-scale sell-off wouldn't just trigger a price correction. It could ignite a confidence crisis. Once markets sense panic, algorithms kick in, stop-loss orders trigger, and a rapid cascade of selling could send indexes like the S&P 500 or NASDAQ plunging. We've seen this playbook before in 2008 and during the COVID crash. But this time, the driver wouldn't be a bubble or a virus. It would be a loss of global faith. Then there's the U.S. dollar. As foreign nations reduce their dollar reserves and shift to other currencies or commodities, the dollar could weaken dramatically. While a weaker dollar might boost exports, it would also raise the cost of imports, from electronics to fuel, hitting American consumers hard. Inflation could return with a vengeance, especially in an economy still reeling from previous price surges. Another under-the-radar effect is shrinking foreign investment in real estate, infrastructure, and startups. Cities like New York, Miami, and Los Angeles rely heavily on foreign capital inflows. A pullback could lead to layoffs, slower growth, and declining tax revenues at the state and local levels. In short, the flight of capital is not just a financial story. It's a national risk. It affects jobs, interest rates, consumer prices, and even the political stability of the country. The real question isn't whether America can survive this shift. It's whether the leadership is ready for it. If there's one lesson from history, it's this: capital moves faster than governments react. And right now, the early signs of a shift are already flashing red. The $41 trillion warning isn't just a scary headline. It's a reflection of changing global sentiment. The trust that once made the U.S. the center of the financial world is starting to crack. So, what can ordinary people do? First, stay informed. Too many investors are still operating under the assumption that the U.S. is invincible, that the dollar will always be dominant, and the stock market will always bounce back. That mindset is dangerous. Understanding the risks of capital flight, inflation, and currency devaluation is the first step in protecting your future. Second, diversify globally. While we don't give financial advice here, it's worth noting that many major institutions, from sovereign wealth funds to private investors, are increasing their exposure to emerging markets, gold, commodities, and non-dollar assets. The global financial map is changing, and smart investors are paying attention. Third, question the narrative. When the media says, "Don't worry, everything's fine," that's often when it's time to look deeper. Follow the money, not the headlines. Most importantly, don't panic, but don't be passive either. Prepare, adjust, and act. Because if even half of what Bank of America warns comes true, those who stay ahead of the curve won't just survive, they'll thrive. Thanks for watching. If you found this video helpful, smash that like button, subscribe for more real talk on finance and geopolitics.